Hi everyone, I hope you're doing well. So today we are going to go through WACC, what I'd like to call WACC. So let me just quickly share my slides with you so that you can see what I am talking about. Okay. Okay, capital budgeting 2, this is our second class. We have gone through the payback period, how to calculate the payback period, why the payback period is important, who actually is interested in knowing about the payback period, and how does it differ from each and every project that you might decide to take or not take. So we've looked at all the possible advantages and disadvantages. So this is the second class where we will be calculating WACC. So you have time and risk, of which we have looked at also when we're looking at the payback period, to say when we're looking at payback period, we need to factor in certain things such as time and risk, and that is why we need to know whether our investment will materialize or not. Okay, then why we use payback period, we use so that we can know or project future cash flows, but it does not mean that they will be accurate, but it's just a little bit of what is it that you need to expect when it comes to that. Sometimes we just use it for us to have a rough understanding, a general understanding, but it does not take into account certain things such as inflation. It does not take account certain things such as the project might have positive cash flows in the first few months or few years, but the project might not do so well after some certain years. So I want to go straight to the WACC, which is the weighted average cost of capital, where we're looking at what is the impact of taxation when it comes to the projects that you might have or might take when it comes to your new adventures. Okay, so here we're looking at the present value, we're looking at the future value. The PV that you see here, it denotes present value. When you see an FV, it denotes the future value. So it's the same thing as you did in mathematics, where you had the FV is equals to PV open bracket 1 plus R or I raised to the power of N. But here we will go in detail. So what is the formula that we use when it comes to WACC? We use the formula that says the cost of equity multiplied by the percentage of the equity plus the cost of the debt multiplied by the percentage of the debt multiplied by 1 minus t, of which is the tax. Why is it that it's important for tax to be considered, and why is it the tax is considered on specifically the debt and not the equity? The tax is important for us to know how much we need to pay for taxes, because remember, you might have cash flows, but if you're also still considering the amount of money that you need to pay for tax, you are not getting a clear picture. So we need to know exactly how much we need to pay for tax so that we can be able to remove that from the money that we are expecting as our cash flow. So you will see this as we're doing more and more calculations. So we'll start from where do we get this information? You look at your balance sheet. You will be given sometimes a balance sheet for you to extract the information. At times, we're just going to give you the values as they are, and you just need to know where to get the values or where to plug in the values. As I said, cost of equity. You are usually going to be given a percentage. You are going to be given a percentage that is associated with the debt. Let's just make an example. You want to borrow money from ABSA, and that particular bank, ABSA, says that will charge you 10% associated with this particular debt. So that is the cost of debt. Same thing with the cost of equity. If you are starting a business and you want to invest certain things, you know that there is an opportunity cost that is associated with you investing in that business. You could have easily decided that you want to use that money for something else. So what is the cost of you investing in your business? That is what we're looking at also when it comes to the cost of equity. So where do we get these values? As I said, usually in the balance sheet, or we will give you the information as it is. It can come as total equity. If you see it on your balance sheet, you will see total assets. Remember, the total asset is the liability, and the equity, we have the ROE, of which is going to the percentage that is attached to what? The equity. Then for the liabilities, which is our debt, you are going to divide that by the total assets, of which is going to be your liabilities, and your equity, and you multiply that by the loan interest. Like I was making an example of ABSA. If you get a loan and they tell you that they will charge you 10%, that will be the loan interest that you need to put in there. Then you need to subtract the corporate tax, of which is usually given. Then you add all these things together and then you multiply by 100. If we are given preferred shares, we also add them. So how would we add the preferred share? Preferred shares, you will have your total equity divided by total asset, multiplied by the ROE. You will have your total liabilities divided by total asset, multiplied by the percentage. Then you also still multiply that by the 1 minus t. If you are given t, then we're going to have here a plus total assets that are preferred divided by the total assets, and then you also get the percentage that is attached to it. But let's see if we can make use of an example. So you'll see that I'll juggle between the slides and also the Word document so that I can be able to do the calculations. So we are given this example. Let's see if I can go to this example and then create a new sheet. Let's see if we can, yeah, and have that. I'll just do this so that we have a glimpse of everything. So now we are given this information and they're asking us calculate WACC using the information that is given here. If you do not understand, please go back to the recording so that you understand what I was saying. But if you are in alignment with what I've just said, let's do the calculation. WACC will be equals to the weighted, you'll see the weight of debt, then you multiply that by the rate of return that you are expecting. But because it's the debt, is the rate that the bank is expecting from you. So it's the way R, which can be denoted by RD, the rate of return for the debt. Then you say 1 minus T. Remember, that is just the formula. You multiply that by the weight of equity and then multiply that by the R for equity. Then if we have preferred shares, what are we going to do? We're going to say the weight of preferred shares. And then you still multiply that by the rate of shares. Let's just call it RS. Okay, where do we get this information? Let's just make this a little bit bigger. Where do we get this? Okay, let's start with WACC. We say the weight of the debt. You take your total liabilities. Let me just put on insert. And then we can have our equation here. Obviously, if you're doing this with your calculator, you don't need to be doing what I'm doing. I'm just trying to explain. Okay. Okay, let's just leave it. Total liabilities. I think it's because it's not big enough, but it's fine. Total liabilities divided by total assets. Then you multiply that by the rate which you will be given. Then you have also 1 minus the tax. Then you plus the weight of the equity then. Then we have our equity. You have your total equity. Then you divide that by your total assets. And then you multiply that by the rate of equity, ROE. Then you still plus the weight of the preferred shares. Do we have preferred shares here? They only gave us total equity, retained earnings, ordinal shares, preferred share capital. So we did not get the preferred shares. We just have a share capital. So those are two different things. If we're given preferred shares, we will know exactly how to go about calculating that. So let's see, we still can say preferred shares multiplied that by the rate for preferred shares. Okay, then let's go on. WACC, if you're still with me. What is the total liabilities that we are given? We go here. Total liabilities is 22,723. Then you divide that by total assets, of which is your total equity and the liability, which is 59,700. 1, 2, 3. And then you multiply that by the rate of which it is attached to the debt. So how much are you expected to pay back when it comes to this particular debt? You have it here. The loan interest is 10%. So you can have it as a percentage. If you choose, please do not forget to put the percentage when you're doing the calculations. Then do we have taxes here? Yes, we do have income tax that is associated. So we're going to have 1 minus 28%, because remember our formula says 1 minus the tax. I hope we're still on the same page. Total equity, we have it there at 37, 123, 123. Then divide by total assets, of which is 59,700, 123. Then you multiply that by the rate of equity. The rate returned for equity here, the required ROE, which is given as a 12%. Do we have preferred shares? No. Do we have the rate for preferred shares? No. So we keep that as 0. So WACC. Okay, if I go to this so that we can be able to make sure that we are all on the same page. If I say 22,700 divided by 59,700, I get my answer. I multiply that by 0.1. I get my answer. And after that, I multiply that by 1. Let me not use 1. Multiply by 0.72. Why am I using a 0.72? Is obviously I'm not using a scientific calculator here, so it might mess up some of the calculations. So if you put on your calculator as it is, you will get the same answer. But 1 minus 28% is 72%. So that is why I'm already multiplying it with a 72. So if you get this fraction side, it's 0.0273. Let's just keep it 1, 2, 3, 4, 5 decimal. So it's 0.027377. Okay, that is 78. Okay, then now we have done this part. This is the part we were just doing. Let's do it again so that we make sure we're all on the same page. We have 22,700 divided by 59,700. I got my answer. I multiplied that by 0.1. I got my answer. I multiplied that by 0.72 because 1 minus 28% is 0.72, which still gives me a 0.02738. 0.02738 is. Okay, now let's move on to the next one, of which now we have a 37, 1, 2, 3, divided by a 59,700. We have that multiplied by 12, not 12, 0.12. Then we find our answer to be a 0.07437. Yes, 372. Okay, then we're calculating our work. Obviously, we have the 0 on the other side. We don't always have to carry on the 0 because obviously if we add a 0, we are going to get the same answer. So we're going to take 0.02, sorry, 738 plus a 0.074372. Hope I wrote that right. Yes. Then we are going to have a 0.101. Then we multiply the final answer by 100 for us to get a work of almost like 10 multiplied by 100, 10.17 as the percentage, or 1/8, depending on how you round it up. Usually you can put all of this and then you will get the correct answer. I just had to round up because I was not using a scientific calculator. Let me go through this again. We were given this information and they asked us to calculate the WACC. We have a total equity, total liability. We didn't get preferred shares at this particular point. If we did have, we were going to include them. So WACC is equals to the weight of the debt multiplied by the rate of the debt, multiply that by 1 minus T, plus the weight of the equity multiplied by the rate of equity that you need to return, plus the weight of the preferred shares multiplied by the rate of that. So we had the what? The weight of the debt was the total liability divided by the total assets multiplied by the rate still, of which is the RD that we had here. Then we still had the 1 minus tax plus the total equity, which you will be given here. Then you divide that by the total asset multiplied by the rate of equity. Then if we had the preferred share, we were going to also include them here. Where did we get the values? Total liability, where our total liability is 22,700. I put the 22,700 divided by the total asset, of which is the total of the equity and the liabilities together, 59,700, still multiplied by the rate of debt. How do I know which one was the rate of debt? Because obviously loan interest is associated with the debt that you might have taken. So that was 10%. Then the tax was here also to be 28%, plus the total equity, 37. Then we divide that by the 15, out of which is the total asset, multiplied by the 12, of which is the ROE, the rate of equity. And then we have the 0 because at the end of the day, we didn't have the preferred shares, and then we did our calculations. I hope this helps. We can also look at other examples. Let's see. When we're looking at this one, if we can get answers for this. I have like a few examples that I put here. Okay, we're looking at the debt. We're given debt to be 30,000, the equity to be 70, the cost of debt to be 4%, the cost of equity to be 10%. Can we calculate this? Definitely. WACC, we say equals to the weight of debt multiplied by the R debt, and then you already know that there needs to be tax implications that are included there, plus the weight of equity, and then you multiply that by the rate of equity, make it small, then you plus that by, do we have shares here? We're not given, so we don't have to worry much. WACC, the weight of the debt, we have the 30,000. Then you remember, let's start here with the formula. The weight of debt, you're going to have your liabilities, or you have your debt divided by the total assets, and then you multiply that still by RT, then you multiply by 1 minus T, then you plus the weight of equity. We're going to have your equity, then you divide that by total assets, then you multiply that also by the rate OE. Okay, then WACC, then now I'm substituting. WACC is equal to the debt that we given here, 30,000, divided by, what is our total asset? It will be the equity and the debt together, which gives me 100,000, multiplied by, what is the R for the debt? Is 4%, plus, okay, what is it that I forgot? Is the taxes. 1 minus the taxes. What is the taxes that we're given? 25%. Then we plus, what is the equity side? Equity is the 70,000 divided by 100,000. Then we multiply that by the rate or the cost of equity, which is 10%. Hope everyone by this time is following through. Okay, let me get my calculator. So how do we go about this? 30, 1, 2, 3, divided by 100, 1, 2, 3. I get my 30%, multiply that by 0.04, which is my 4%, gives me this, and then I multiply that by 0.75. Why is it a 0.75? Obviously, if we say 100 minus 25%, it gives you a 75. So I already have that to be 0.009. Everything was okay there. Multiply, not multiply, add. Then you say 70,000. And then divide by 100, 1, 2, 3. Then we have our answer to be 70%. Multiply that by 0.1. It gives you a 0.07. If you take this 0.07, let's just make sure we clear that 0.07. Then you add the 0.009. You should get a 7%. So work will be equals to 0.079. Then you multiply that by 100. Then you have your work to be, to make sure, 100, obviously it will be a 7.9%. 7.9%. Once you have converted it and you have used a multiplication by 100, you need to include that percentage. The same thing you will apply here, because you have debt, you have equity, cost of debt, you have corporate tax. So it's almost the same thing that we've just done. But what happens then when you are given corporate cost of preferred share? Same thing. You just input the variables and make sure that you get the answer. In our next class, I will ask you for the answer for this particular activity. I hope that this was helpful. If you do have questions, please feel free to contact me. Thank you. Bye.